Hello, everyone. I'm Steve. I am the president of IBC Global, Insurance Business Concepts Global. I am from Northeastern Pennsylvania, although today I'm over in Chicago because I've got a seminar tomorrow for another group, and I'm having a lot of fun here. So what our company does is specialize in whole life insurance policies, but most people we work with have zero care or concern for the death benefit, as we primarily focus on the cash value benefit. So what I'll start with is a couple questions, and then I'll get into a story. So to begin, have you ever heard of using a whole life insurance policy as a place to save money and build wealth tax-free? Have you ever heard of banks, corporations, wealthy individuals using cash value life insurance, specifically whole life insurance? Some have, but how about this? Have you ever heard that whole life insurance is a scam and that some people have been absolutely ripped off with it? The thing is, both statements are 100% true. A whole life insurance policy can be a great area to put money, but it can also be a horrible area to put money. So I'll share a quick story. In 2011, about a year after I graduated from college, I got my life insurance license because I had a dream of always being a life insurance salesman. I'm completely kidding. That was not that was not my dream. I can share exactly how I got into the business another time. That's a different story. But anyway, about a year in, 2012, I'm about 23, 24 years old. I'm working at an office and I am struggling, but I'm seeing everyone around me doing very, very well. Doctor walks into the office that I work at. He had a meeting with the owner and a manager at that office. The guy throws a book on the table and says, I want to pay $100,000 per year into a whole life insurance product. And again, I'm barely getting by in the industry. I just hear 100 grand into a policy. Like, what is going on here? The thing is, through reading that book, the doctor had learned a lot about the cash value benefits inside of a whole life insurance policy. And he wanted a whole life insurance policy specifically for the cash value. And it was for the following reasons. One, he saw that it was a safe area to put his money, that his cash value would continue to grow regardless of what happened in the stock market, the economy. And this was 2012, so not too long after 2008. He also read that he could access his cash value anytime he wanted. And he saw something very similar to how he leveraged his real estate, in the sense that when he would access his cash value, his entire cash value balance would continue to compound as if he never touched it in the first place. I'll explain exactly how that works as we progress through the presentation. And then the third reason, he learned it was tax-free, and that attracts everyone, frankly. So all sounds good in the book as to why the doctor wanted this whole life insurance policy. However, what he bought or what he was sold was not what he read about. He was sold a whole life insurance policy, but he put that $100,000 in, and in the first year, his cash value was just about zero. So if you're that doctor, because this is a real story, how would you feel? You read a check for 100 grand and your plan is to continuously pay 100 grand every year, and you've got a goose egg to show for it in the first year. You can imagine what that agent's compensation was as well. It was quite rich in that case. So we'll come back to this story throughout the presentation, but the purpose of today's presentation, what I want to cover with you is, one, how whole life insurance works, particularly the cash value benefit, and then two, provide enough information really so you can determine if it's something that benefits you or not. So with that said, let's get on into it. We've got the three core benefits to the cash value of a whole life insurance policy: safe, liquid, and tax-free. So beginning with number one here, I'm beginning with the three benefits, or the why. Why do people use whole life insurance? Well, we've got the core benefits: safe, liquid, tax-free, a little bit more information. Number one, safe. When we look at a cash value life insurance policy, the net growth rate, like what is it actually growing by, will range somewhere between 3 to 5% if the policy is set up correctly. And I will elaborate on exactly what "if it's set up correctly" means. Your money will continue to grow, and this is regardless if things are going very, very well in the economy and stock market, or if we're in a recession, if things are going very, very poorly. I'll say this, after 2008, a lot of people, their interest was drawn to whole life insurance because they saw those guarantees and a safe area they could position money that just continued to appreciate over time. The liquidity. So the cash value can be accessed anytime. Anytime you want to access the value, even if it's 10 days after you start a policy, you can do so very easily. And a unique feature is that that cash value will continue to compound when you borrow against it. This works a lot like real estate, and we're going to look at a specific example on this in a little bit. As far as accessing the money, well, that's easy. You can do it through an online portal, mobile app, or call your agent or the insurance company that you're working with. And typically, funds are sent via direct deposit within 3 to 5 days. So it's very, very convenient, especially being a business owner. Time's extremely critical. When I've got an opportunity, I want cash fast. And that is a nice feature with the direct deposit there. And then this piece, tax-free. Who doesn't like that? The cash value can be accessed tax-free anytime. I will add this, that taxes can occur with cash value life insurance policies if things are not done correctly. We've got a ton of information that I can send. I can address this in the Q&A at the end as well, but it's not automatically tax-free. And just for full disclosure, we always like to add that the fact that taxes can occur with these products. So a couple bullet points here on the cash value. Number one, no risk. How that works is that your money is not invested in the stock market at all. Where your money is positioned is with the insurance company that you purchase a policy with. Got a couple components here. Number one, you've got a guaranteed rate that typically ranges between 2 to 4%, depending on the company and product you select. But whatever your guaranteed rate is, you're locked into that for life, literally until age 100. You can never earn less than whatever that guaranteed rate is. Dividend rates. A dividend rate is the guaranteed rate plus any surplus the insurance company declares. You'll find with the top companies out there, which are MassMutual, Guardian, New York Life, and Northwestern Mutual, those are their 2022 dividend interest rates. They range between 5 to 6% right now. Number 4, flexible payments or contributions, not a boring bill, right? So we all have insurance. With any insurance policy, how does it typically work? I've got a premium. I pay that premium every month, every year, the same amount. And if something bad happens, well, then a benefit's paid out. It's not something that people are attracted to naturally. The thing with a life insurance policy, a cash value life insurance policy, is it can be set up to be very flexible, where your payments can actually adjust over time. And what you'll find, what a lot of people we work with do, is commit to a minimum amount, typically that premium piece, and then just pour more money into the cash value area, which they can access. They can pull the money back out if they want. It's very flexible there, and we can explain more on how that works. Here's a fun one. You're not required to make payments for your whole life, which the name of the product is what? Whole life insurance. Have you ever thought that you had to make premium payments your whole life? Not the case at all. There's a lot of people we work with, particularly real estate investors that have lump sums of money. They're not into the idea of making payments for a long time. So just plop a large lump sum into a policy, usually over a couple of years, let it grow like a high yield savings asset, and then leverage the cash value like a personal line of credit. Payments are made with after-tax dollars, so we cannot deduct them. The growth per the IRS definition is tax deferred. However, it is very easy to access the money tax-free. And again, that's if we do everything properly. And really, when I say if we do everything properly, it's us or the agent that you're working with to make sure they don't mess the policy up. And then number 9, we've got no lost opportunity cost, where I can always access whatever I have in cash value while it continues to compound. Continuing on, we've got some dividend rates here from 2 of the 4 major mutual companies. We've got Guardian and MassMutual. The other 2 companies are New York Life and Northwestern Mutual. I can send this dividend history as well, but this just gives you more than a 30-year look back to see exactly what some insurance companies have been paying via dividend rates over the years. All right. So who uses cash value life insurance? We've got banks, corporations, and wealthy individuals. Everybody does. But a lot of times when people hear of banks, corporations, and wealthy individuals, that generates the why question. Like, why on earth would a bank put money in life insurance or a corporation? So when you look at banks, they do things a little bit differently than individuals. It's completely an asset play where it's just what a cash value life insurance policy is for a bank is an area they can put a big lump sum of money. It looks fantastic on the balance sheet. The cash value is considered tier 1 capital. What that is one of the safest asset classes on the balance sheet. And they just plop it there, let it grow over time, tax deferred. And then when their officers or employees that the policies are on eventually die, the death benefit comes back to the bank. So there's a lot of long-term benefits there. But if you look at some of the dollar figures, Bank of America has the most of all the banks in the US, where it's more than 20 billion in the cash value holdings right now. It's actually closer to 22 to 23 billion, but large dollar amounts. When you look at corporations, so they'll often take policies out on their executives, other employees as well, but more commonly, you'll see them policies taken out on executives, where a corporation or the business, small businesses do this too, owns the policy, funds the policy, controls the cash value. So they're using the cash value for their business over time. There is a benefit to the executive as well. Let's say that I work for Tori and he wants to ensure that I don't leave his company at any point in time. So what he could do is take a cash value life insurance policy out of me. He funds it. He has control of the cash value. His company or Tori is the beneficiary. If I die, that death benefit goes to his company. However, what he says to me is, Steve, if you stay with my company for the next 10 years till age 65, or if you hit this performance quote over the next 10 years, he sets the vesting period. That is, if you meet this vesting period, Steve, I'm going to pay you a retirement benefit. It's almost like a private pension. And what he's going to do is pay it from the cash value he's built up over time. This is an extremely common strategy. You'll see corporations, small and large, use. This was actually my background before I got into the business owner world myself. Before I started my company, I picked up a lot of experience designing policies for corporations, where it would actually model the policies out, maximize the cash value. It's where I learned a lot of the ins and outs of how all of this works. Then you'll see wealthy families use these products as well. What they often do regarding the cash value piece is use it for opportunities. What we see the most is real estate and business opportunities. And then there is a long-term aspect here with generational wealth, where that death benefit is paid completely income tax-free to the family. Next, what should a high cash value policy look like? So we're taking notes. This, in my opinion, is the most important piece, what we're going to progress through in the next couple of slides. So what I want to go through is what to look for, what to do, and then more importantly, what not to do, because this is where people often are taken advantage of or find out after the fact, I wish I would not have done it. So if you're ever looking at a policy or an illustration, for example, have a laser focus on your cash value. Remember that it's your money going into a policy, not the agent's. First, we'll hit on what not to do. So what not to do is to have all of your payment directed toward the insurance premium. Terminology in the industry is often referred to as a base premium. Another example, if you're interested in the cash value piece, is to purchase a whole life policy. Let's say it's a $1 million death benefit, and it costs $20,000 per year. What you'll see in a case like this is very, very low cash value, a lot like that doctor that had 0 in the first year. And it will often take 10 to 15 years before seeing any kind of positive return. So for example, if you're paying $20K per year over 10 years, that comes out to $200,000. And by the 10th year, you'll likely have less than $200,000 in cash value. So a negative return. I like to refer to this as a perfect example of exactly what not to do if you're interested in a policy specifically for the cash value benefit. Here's what to do. And we can often do this with the same policy. All we're doing is choosing where our money goes. we should see high cash value immediately, typically between 80 and 90% of whatever your payment is in the first year. We should have positive cash value between 4 to 6 years. So let's say you're paying in $20,000 per year, 20K over 5 years is 100K. At that point in time, I should see $100,000 in cash value or a little bit more. And in the first year, I should be somewhere between $16,000 and $18,000 of that 20K payment. With this setup, I will see stronger cash value growth. I'll also have a ton of flexibility, so I can adjust my payments over time. I can have a limited funding period if I'm not into the idea of making payments for a long period of time. If I say, hey, I'd like to do this for 5 or 10 years and then stop or pay just a minimal amount, I just want it to be more flexible. If it's set up correctly like this, you'll get all of that. So let's take a look here. What not to do. Remember that doctor? So here's something that he had, or here's what he was pitched on: a basic old school whole life insurance policy. He wanted to pay $100,000 per year to the policy. And this is based on an illustration here. Here's the first year cash value, goose egg. $100,000 in, he's got a fat death benefit over $5 million, but he's interested in the cash value. Again, great example of what not to do. Second year, pays in $100,000. He's got $9,700 to show for it. If we were to look at the guarantees, this would be a 0 again. Now, the third year, he pays in $100,000. He gets the majority of that $100K back, but he's $300K in the policy, $82,000 in cash value. And if you look at what's highlighted in yellow, this is 14 years down the road. He's 59 years old. He's paid in $1.4 million, and he's got just over $1.4 million. Not attractive. This is how the majority of whole life insurance policies are sold, where they're just basic all premium policies, this annual funding. He's just paying a premium bill here. All goes toward the death benefit and eventually builds cash value. A lot of times people will cancel these after they start to see that the value is just taking so long to build up. I wouldn't want it. Here's a better example. So this is the same company, same individual, same health rating, just call it re-engineered or redesigned. Same 100K per year for 15 years. Big difference. Instead of a 0, he's got just about 89% right out of the gates. Instead of 14 years to get his money back, highlighted in yellow, between years 4 and 5. Year 5, he's paid in $500. He's got $509. 15 years in, he's paid in 1.5, getting close to 2 million. And again, this is with no risk, not tied to the market either. A lot of times people, they'll either look at this as a bond alternative. It's very common to see that, or someone will look at it almost as a bank account alternative, somewhere to position safe money, but then have access to it for opportunities. So which one would you choose? Which is kind of a no-brainer question. On the left, we've got that traditional policy. This looks like a lot, but I promise it's not. Just a side by side. There's the bad example. Here's the good example. And in purple, we've got the cash value difference column. Again, the exact same insurance company. These examples are with Mass Mutual, both with an ultra preferred individual with a dividend rate of 6%. All we're doing is setting up one policy where it's all insurance, the other one, minimum insurance, maximum cash value. And then we see a big difference. We look at the 15th year, no matter how long I do this, this will always fascinate me. You've got 400 grand more simply by choosing where the money goes. And on the far right, here's the exact same policy as this one, the good looking one, but with a difference here. Stopping payments all together after the 5th year. And that's just meant to demonstrate the fact that we can stop early. This may have been the plan when he first started the policy, or it may not have been the plan. A lot of times people will adjust after the fact. Hey, I plan to pay into it till I was 60, but you know what? I've got some other things going on. Let me shut it down, or maybe I'll pay a reduced amount. He can bounce those dollar figures up and down. So it's very flexible. So here's what I would ask an agent. If I'm you, if we flip positions and I've got the knowledge that an insurance agent should have, and I'm trying to make sure a policy is set up properly, I would ask, where is the money going? Because if I'm going to pay any dollar amount to a policy, we just looked at 100 grand, similar to what that doctor was looking at, but here's $10,000 per year. Money can go toward that base premium, which base premium dollars typically give you zero cash value in the first year. It does not get that much better in the second year, and takes 10 to 15 years just to get your money back. Or here's the insurance term. PUA stands for paid up additions. I like to refer to this as a cash dump-in. And in the first year, you won't see 100% of this show up in cash value. Depending on the company and product, typically between 90 to 95% in the first year. And then if we look at just the PUA payments, it does begin compounding by the second year. This is the key right here to accelerating the cash value growth of a policy, and it copies what corporations do. Simply, if I'm paying in 10 grand, how low can I go in the premium? And how high can I go on that PUA rider? That's the key there. Now, there are some things we want to watch out for here. This modified endowment contract. What this term refers to is any life insurance policy, or if I back up and go to the core benefits, do you remember what those are? Safe, liquid, and the third one was tax-free, which attracts a lot of people. Any life insurance policy can become classified as this MEC. If it does, that third core benefit, the tax-free piece, is out the window. So we want to make sure a policy does not become classified as a MEC. It is easy to prevent. It's mainly the responsibility of the agent. However, you'll always see on an illustration or on your online portal, if you have a policy, if you are at risk of triggering a MEC, which would be a taxable event. But when we have an aggressive policy, we do want to look out for that, and we want to forecast it in advance. It's typically not a surprise after the fact. So with all of this said, because I know this stuff can be complex here, if you're asking for a high cash value policy, and if we're really pressing someone saying, no, here's the dollar amount I want to pay in, I want this premium minimized because I'm interested in the cash value first and foremost, there's a good chance you're going to get resistance from agents, people who are selling the policies. If you're asking for that high cash value product, and it does have to do with the commission, a lot of my peers will often push back on this. And here's why. So just to show you everything here, remember this chart? This is what we looked at as far as the traditional policy for the doctor. Everything going toward the premium piece. Premium dollars don't build cash value for you in the first year. But here, so this is the comp rate with this product, and these are based off the comp rates we receive, my office, and our company. So about 93.5% in the first year. Like that's a fat commission versus that high cash value design. So same out of pocket for the consumer, same insurance company. The only difference is the premium piece is minimized, cash value is maximized, death benefit is lower as a result, but that compensation is significantly reduced at $7,600 in the first year. And there are residuals with life insurance sales, typically through the 10th year. Beyond the 10th year, there are small 1% to 2% trails. A lot of times they'll stop though, so I just made it 10 years for this basic example. But this answers a lot of people's questions right out of the gates, like why is not everyone shown this, the high cash value product? Because it kind of screams at us. With this option, one would make more in the first year than this guy over 10 years, and significantly more as well. We look at the far right, exact same thing, just with payments stopping after 5 years, and there's the compensation. So it is common to get pushback there when we look at high cash value policy sales, and a big reason why is because if any agent is used to selling products with higher premiums, that can be a difficult pill to swallow if they're used to it already. Just speaking from experience, not trashing any other agents by any means, as we would never want to do that. So that's how we maximize the cash value. how can we use it? Because a lot of people we work with, particularly on the business owner and real estate investor side of things, like the idea of growing their cash value, but often they want to be able to access it to really invest in themselves because that's where they're getting the highest return. So if we look at real estate investors, for example, they'll use the cash value or cash value policy as a tool to build their net worth. And here's exactly how it works. Once a dollar passes through the cash value of a life insurance policy, it's always compounding. Policy works similar to a line of credit that you would have against, call it your primary home or a piece of real estate. The difference is you've got complete control over how you repay policy loans. And I'll add this quick side note: when people hit retirement and have no intention of borrowing or repaying, they're just taking income and not paying anything back. Again, if we do everything right, that generates a tax-free income stream. So let's pretend for a moment you own a piece of real estate. Let's say it's your primary home, and today the value is $1 million. You take a line of credit or mortgage against it for $500,000. You've got $500,000 remaining in equity. The interest on the loan is paid to the bank or lender, whatever that interest rate is on the line of credit. Now, that $1 million home, we're going to pretend that it's appreciating by 5% every single year, like clockwork. Regardless of what happens in the market, your property goes up by 5% every year. You've got a sweet deal. Let's just call it that. If you take that $500,000 loan, what happens here? Do you receive the 5% appreciation on the entire property value or only the remaining equity? The entire property. That's why a lot of people like real estate. So how life insurance policy works is almost in an identical fashion. So example of a policy, we're going to look at some numbers right after this. Let's assume you've got cash value of 100 grand here. We'll assume that the net growth rate year over year is 5%. Let's assume you take a policy loan for $50,000. We'll assume that the cost to borrow is 5%, the loan interest rate. Whatever that loan interest rate is, it is always paid to the insurance company. Now, if I borrow $50,000, I start with 100K, took a 50K loan, so I've got remaining cash value. I like to think of this as remaining equity of another $50,000. That 5% net growth rate is still applied to the full $100,000 as if I never borrowed it in the first place. This question often comes up here. How, specifically, how do insurance companies do this and why would they do it? Here are the reasons. One, when we borrow against the policy, they do charge interest for the loan. So that does generate a form of profit that offsets the interest they're crediting us. But then second, collateralize the death benefit. As an example, if I've got a $1 million policy with 100 grand in cash value and I borrow $50,000, what'll happen is my death benefit the next day, I would see it on paper, $950,000. So if I die with a loan outstanding, the insurance company is going to pay that death benefit out minus whatever the outstanding loan is. I love these charts, right? So I'll walk through this. On the left, we've got an example, 45-year-old individual paying in 100 grand per year for 5 years and then nothing in thereafter. This model displays what the policy looks like if he just parks money, lets it sit and grow. Here we've got rich cash value up front, about 92% of our total payment, breaking even between 4 and 5. Over here, we've got what the cash value is actually growing by net each year. So again, even when we minimize the premium, maximize the cash value, it's an $8,000 hit, just about an 8% hit in the first year. Second year, slightly negative, and then I see it growing by more than what I'm paying in. That's the dollar amount it's growing by each year. I like to highlight this because when people borrow against their policy, they like to see what am I paying in interest versus what am I earning in interest over here. Does it benefit me or does it hurt me? Can I see some actual numbers instead of just hearing, hey, it's a good idea? So at the far right, we got the same policy and what it looks like when we borrow and repay And this is the current interest rate here. And this is a Mass Mutual product as well, 4.67%. So we can take loans anytime. Here's a $300,000 loan. If this is you, here's what I would want to know. What is the impact that this loan has on my policy, specifically my money? Here's my cash value. Before I took a loan, 529, took the $300,000 loan, it's worth 215, drops by just about the amount I had borrowed. Look at the column to the right though. Death benefit, 1.5 million. What was it in the example where we didn't touch it? 1.8 million. Going back to where the company collateralizes the death benefit, that's exactly how it works right there. Now in this example, here's my loan interest that comes due. We're assuming we're paying the loan interest every year in this example, which is optional, and then also applying 30 grand per year toward the balance. Most people we work with will pay their loans off somewhat sporadically depending on their cash flow. Some take a very disciplined approach, but you can attack it however you'd like. It's actually optional. You don't have to pay it back, although that typically doesn't make sense unless I'm in retirement. Here's what I want to hit on. In this example, when it's paid back, cash value 794, death benefits 1.8. To the left, what do we see here? 794 and 1.8. So everything's fully restored to exactly what it would have been as if I never touched in the first place, meaning those gains there just continue to compound year in and year out. So my point is there where people are attracted to this is they really view it almost as a personal line of credit that's guaranteed to appreciate over time, that they can access for other opportunities instead of having excess cash in the bank. See, a lot of people we work with do exactly that. So last thing I want to hit on, that's a lot about the cash value. And again, that is what our company specializes in. But what about the death benefit? Sometimes people do ask about that. And a couple quick side notes here on the death benefit is that it is paid income tax-free. Families will often use it to create generational wealth. And we get a lot of attraction there. And where you'll see it in the corporate side is it's a great means to recover employee costs. So you'll see companies, particularly banks, use it when they get the death benefit back. It reimburses them for health insurance costs, payroll tax, 401k matches, and everything else that comes with employees. But a little bit in the death benefit there. Let's open it up to questions if we have any. We've got contact info there in our website and YouTube channel as well.
Okay, nice work, Steve. All right, look at the test that we have happening here today. Normally in your workday, you have little bits of concentration and lots of mental downtime. But today, it's been hour solid of having to pay attention, which most people's minds aren't used to. That's why a lot of people in here will get tired because you're not used to having to really concentrate for sustained periods of time. And there's a lot of math here. This takes some work to really process. But now that he's gone through this, and this is beautiful work, Steve, let's have some questions here, because this is big and you'll know more about this than almost anybody in the world when it comes to this stuff, certainly your friends and family. So here we are, questions time. Go ahead right here.
So I take out a life policy and I pass away. Does my family have a choice on if they could take out that money or just continue that policy for future generations?
Good question. So no, they'll receive the net death benefit on paper. So what happens actually in that case is as you're building that cash value over time, you'll see long-term that death benefit will be pushed up with it. So what they'll receive is the death benefit. However, what I'll add is what a lot of individuals do, families in particular, is often set a trust up where the trust is the beneficiary, and they'll specify that a percentage of that death benefit is going to be used to take out new policies on the children. And then they'll have some restrictions there as far as how and when and why the children can use the cash value in the policy, because they want to make sure that the death benefit continues to grow over time and just continues to be passed from generation to generation. Let me know if that makes sense, because that was a lot of extra info I threw in there.
Question. Go ahead, Brett.
On that cash value, the second chart that you showed us, I guess I'm confused because you say that there's flexible contributions, but you have to have a minimum. So when you stop paying at one point, I thought you had to have a minimum.
Good question. So what you can do is typically the minimum. So we can typically set the minimum at 10% of whatever the total desired payment is. So if I'm paying, call it 100 grand per year, or that's my target amount, often how we'll set it up is the minimum is only $10,000. And then what happens in a case like the one we saw where I'm paying in, let's call it just for 5 years and then nothing thereafter, when someone doesn't want to pay payment or make payments to the policy anymore, they've got two options. One, they can have the premium paid for internally, meaning the cash value can pay the premium internally. Or two, we can actually eliminate the premium altogether. We can do that after the first 7 years. That's to do with the IRS limit, but we can chop the premium off, which means I cannot pay anything into the policy, but you'll see a lot of people do that. It's a nice means to maximize the cash value growth, but we eliminate the premium altogether and just watch it grow. If that makes sense.
Oh, barrage. Let's go from the back to the front. Cliff, and then we'll go over here.
But money boss probably already has this figured out, but to be honest. So if the companies are paying the life insurance policies through the companies, are you having to offer it to the employees also? And how do they get the benefit from that? You know what I mean? Because looking at it previously, like me and Christy, me and my wife can't just buy us the health insurance policy through the company without offering it to the employees, correct?
Correct.
So how do we get around that? Because I mean, if you're doing it through the company.
Because health insurance has nothing to do with life insurance.
No, I'm talking about the life insurance.
Yeah, okay, go ahead.
The side of it.
Yeah, meaning, can you offer it just to a couple of people, not everyone? Because health insurance, I know what you mean. If I offer it to one, I've got to offer it to everybody.
Well, I know you can't do that. How do you pull it out or if an employee quits? How do you manage that? Might be more of a question for accounting.
Got it. So how,
They're buying life insurance policies through the companies.
yeah,
Yeah.
got it. So sorry.
That's what I'm saying. We're
In other words,
we can't-
yeah, some companies buying a life insurance policy on an executive. Well, how come I can't can't I use a business expense to buy a life insurance policy on myself?
Got it. So what you'll typically see with the companies that are taking policies out on their employees is they're not deducting the premium payments. So how it's set up is a non-qualified deferred comp plan. So it's still funded with after-tax dollars, which grants them access to the cash value. We get that question a lot. Can I deduct the payments and still access the cash value? Which I wish, but no, the IRS, they'll sniff that out.
Okay, up here. Who's next up here?
I have a strange question when it comes to the death benefit. I've been overfunding. Western Reserve is the one I've used, I guess. I don't know. The insurance cost, when I was 15 years younger, was a hell of a lot less than it is now. How do I know when I just put money in there and just don't think about it for 15 years, it's auto funded, that I'm getting a good deal with my cost of death benefit versus when I do a term policy, I'm checking and saying, what's this company doing versus that company versus that company?
Yeah.
I'm kind of stuck as a consumer, and you've got me, so I'm just curious.
Got it. So you've got a policy for about 15 years old, and you're seeing the costs go up each year?
Well, yeah, the cost for the insurance goes up each year. Every year I get. So I'm only putting $1,000 in a month, and so that means I'm overfunding in the beginning by $900 a month. Now I'm only probably overfunding by $500 a month.
I got it.
Yeah.
Yeah. So what we'll always look at is a whole life insurance product that's got a guaranteed level premium, so that premium does not increase. You will see cash value life insurance. It's also termed as permanent life insurance under the name universal life. It could be a variable universal life or indexed universal life, which is exactly what you just described, where each year as you look at it, you'll see that cost gradually increase. And what that means is if your payment's the same, more and more is going toward insurance expense, less toward cash value. And that's where you kind of get in a situation like, all right, what do I do now? And there are some things you can do, some maneuvers to reduce the death benefit, reduce the premium. There's a couple levers you can pull, but you want to explore options first, obviously, which we can help if you'd like.
Oh, very good. Okay, here, good, right here. Okay, go ahead.
Just a question on term policies. So, would you recommend those? Do you recommend staying away from those? I mean,
Yeah.
probably you're in whole life, so.
Yeah, definitely. So I've got no problem with term insurance. It definitely serves a purpose as far as getting life insurance protection. If I've got debt or if I just want to get life insurance at a very low cost, that's where term is a great fit. With whole life insurance, people we work with, 99.9% say, I don't care about the death benefit. It's always a cash flow play where someone says, here's how much I want to pay in. Here's how much I want the ability to pay in, or I've got a lump sum of money. And how do I get as much cash value possible with the minimum amount of life insurance to minimize my costs? And the death benefit kind of is what it is with those products. And it ends up being a lot long-term too, typically. But to answer your question with term, we do sell it on occasion when someone is focused purely on death benefit, or if they want a cash value product, but we don't want to put the death benefit too high because it ends up hurting them. So we'll go for just pure cash value and then a small term policy to supplement. But it has a place. I mean, I've got zero problem with it whatsoever.
I have both.
Mhm.
Very good. Okay, right here, Emily.
So when you get to a certain point with the cash value that you're comfortable with, would that be a good opportunity to like buy your forever home? Because basically you're taking a loan from yourself, so you just be paying back yourself instead of a bank.
You got it. Yeah, correct.
Absolutely do that.
You got it. Mhm.
It would,
Mhm.
I'm sorry, Steve, go ahead.
I was going to say, and what I'll add, because anytime we're looking at loans, like when you borrow and repay, it looks like what we looked at in that model. I see everything restored and it's great. However, we do like the model too. What does it look like if I only pay the interest? What happens if life happens and I can't pay anything back? And then you can see before you take that loan out, or even after it's done, here's your policy with no loans. And then here's what it looks like with interest only payments, not paying anything back. And is there any risk where the policy could lapse or anything like that? Just the little things that, again, are more so done on the agent's end, on our end, to make sure that we don't run into any traps down the road.
Emily, on sheer math, you probably end up ahead that way. But it would be my recommendation that your goal here is to end up with a pile of money. And there's a behavioral problem here. In everything that I'm teaching, I have to try to eliminate the behavioral problems of human beings. For example, if I have a bond and it goes to 12 years and they take my 100,000, they put it back in my account. Yeah, put 100,000 into a bond. It pays me 5%. And at the end of 12 years, I get my 100,000 back. That's sitting in my account. Now I have to make a phone call and voluntarily tell them to turn around and buy more bonds. And that's the problem, because I might go, boy, that new 42 foot with the 1350s. See what I'm saying? That's the problem. That's a problem in crypto land. Nothing automatically reinvest. See what I mean? You have to voluntarily go in and do stuff. Okay. So normally we don't want to take loans because we run the risk of not paying it back and you end up with nothing. You put the money in, you have a loan, you end up with nothing. You just played a big shuffling game and ended up with nothing. So a lot of people can do it, but you have to have incredible discipline. It would be my recommendation. You just get a mortgage for the house. You save up the money, put down a decent down payment. You leave this alone. You don't ever touch it and let it just grow like this all the way until you want the money. Okay, for the simplest, most surefire way to do it. Okay, I used to buy a lot of real estate tax lien certificates. You know anything about those, Bill? I had tons of them. You know what that is? Okay, very quickly for people who don't know, some people don't pay their property taxes, say down in Arizona. So I pay their $2,400 property tax bill. And if it goes, say, 3 years, whatever the time frame is, and they don't come back and pay it, I own their house, free and clear. Okay? And I've had hundreds of these, all right? Now, most of them are going to come back and pay, and they're going to have to pay interest, and then I get my money back plus the interest. Okay, and I've had it where I acquired some $15,000 lot or some $7,000 chunk of dirt that was a sliver in between two houses or whatever. But very few people score and get some sort of $300,000 normal house, although this can happen. What my point is, though, is on these, as I get my money back for the lien, I have to voluntarily turn around and send it back in to buy more at an upcoming sale. And because I'm involved and I have to keep doing it, if I get the check, I'll just go, man, that new boss suit looks great. That's the problem. I got to get it where I can't get my hands on it because I think money grows on trees. Okay. So I got to get it away where I can't toy with it. That's why bonds are good, because they're sort of locked in. The life insurance is, it's sort of locked in. Yeah, you can access it, but it's a little bit of a pain. And the more of a pain it is, the better. Okay. So we don't want to be trying, we want to try to not be taking any loans, although it is a possibility and it is a feature for some. In our world, we're not trying to become real estate investors or anything like that. We want to try to keep it clean. That's really good, Joe. I'm glad you asked that, Emily. Okay, anybody else? We got a few minutes here, like 5 minutes. Okay, way in the back, JW Olson, Minneapolis.
Yeah, so just trying to understand at what age, so my goal would be retirement, probably 8 years or whatever, to start it now, is there enough time accumulation?
Yes.
And then also, okay, now I want a monthly income out of that. So how is that money coming out every month and I'm not having to pay it back, not pay the interest? How does that work?
Just like you described it. You just described how it works. You're going to put in money for 8 years. You're going to stop putting in money and you're going to turn around and have money come back to you. Go ahead, Steve.
Yep. So thank you for that, Tori. That's exactly it. From a transactional standpoint, you can do a couple of things when you're pulling it back out. We can set it up on auto payment, kind of like an annuity where you get a certain amount of income every month, every year, every quarter, however you want. What a lot of people do if they're using it to supplement their income, because it is tax-free, is they often have other income streams from other assets. And then when they want additional income, again, just taking more tax-free, they'll take out lump sums. Hey, I need another 10,000 this year. I need anything. Now I want 50K because I want to take the family on a trip, whatever it might be. Everyone's different. But you can do it however you want, whether you set it up on autopilot, or if you just say, hey, I want to take lump sums when I need them, and what's the impact on it when I take it, and let's say it's a 50K lump sum, what's the impact on the policy, on the cash value and death benefit afterwards?
That is so great. See, a guy like you could pay for 8 years, stop paying, and then your goal is to not touch that until the absolute last end where you absolutely have to have it. Okay, you just let it grow and do its thing. You're not paying any more premium, but it's growing, growing, growing like clockwork. And then you hang on to the, like for me, it's like, if you know, it's the last thing I want to touch. I want to let it go and go and go. And it's the last thing I want to touch. Oh, okay. Now I need it to get me to the end. Okay. Yeah. So he's positioned probably a lot better than he thinks if he did some smart moves over this next 8 years. Because you put some money in there, it starts to accumulate quickly, and it's solid because it just goes like this. Okay. Very nice. Okay. We had one over here. Okay. Go ahead here, Kurt, and then we're going to go back to Brett. Kurt, go ahead.
Just real quick, I don't know, are you able to convert like a traditional policy to a high cash value policy?
You can. There's often a lot of limits that I would always look at it. That's how I'd answer the question. You can, but there are sometimes limits where you might look at and say, it's not quite as attractive. And just starting fresh will be in your best interest, but you can, and sometimes it does work, but often companies just have limitations that restrict how much more money you can plow into that cash value component.
So you just suggest keeping and possibly starting another one?
Correct. Or if you look just to transfer the existing policy into a new one, you could look at that. You do take a bit of a hit then if you've got a traditional one, because you already have lost money. So you have to weigh it out. Do I want to take that loss and roll it over? If I keep it and then start a new one on the side, which one nets me more money, and which one am I more comfortable with being used?
That's exactly what I had. I had a Northwestern Mutual thing, and it was exactly what I didn't want. Okay, it was like a 65-35 deal, Steve. And so I just said, and I got out of it, and I got a little chunk, okay? And then I got a hold of him, got everything set up perfectly. And now, am I doing everything right as it relates to this, Steve?
You are. You're probably the most disciplined individual of the 2,000 clients we work with. Seriously. Or the payments that go in every week. Yeah.
Rigidity in my safety and security. Okay, Brett.
So you said that basically when you end the policy, you start technically giving yourself your own auto payments.
Right.
Does that remaining balance remain in the account and still accrue more cash value, or is it all ended, done? Now you have that one lump sum that you auto pay yourself?
Yeah, good question. So if you're drawing against it, let's say you're just taking 10 grand a month, whatever the dollar amount is, you will see that the cash value, the equity you have access to, will gradually come down. Now, like we looked at in the loan example, you're still earning interest on the total balance. But what happens is if I'm pulling some of that interest out and some of the principal, I'm going to see it gradually come down. It's relative on how much you pull out, but you will see it gradually come down if you're drawing against it.
Okay, so even though you're bringing it down, pulling money out, you're still making
yes.
some.
Yeah.
Well, you're earning money on the reducing amount. And that's something all the way till the very, oh, I'm not okay, I got nothing left. Oh, okay. Oh, all right. Because what we're talking about here, Steve, is that this is a timing game. We want to have the money when we need it, and we want to have enough to have the lifestyle we want until we take our last breath. That's the game we're playing. That's the problem that we're solving here with what we're talking about. Okay,
Yeah.
Any other questions for Steve? Boy, these are beauties. Let's go here and then let's go back to here. Go. You first and then Steve.
Whole life lasts your whole entire life, whether you live to 70 or whether you live to 100, correct?
Correct, unless you cash it out. Yep.
Unless you take all the money out of it, there's nothing left. Okay, yeah. That's why it's called whole life. You don't have to pay for your whole life, but you have a benefit for your whole life, unless you take all the money out of it and there's nothing left. Yes? Look, I'm hoping for the approval from you, Steve. Tell me I answered that right.
Oh, no, yeah, you got it. Yeah, perfectly.
Your person answer. Go ahead, Steve.
Where do you and your company fit into this? Are you like helping us set up one of the big four company policies,
Yes,
or is it
that's
through
all.
your firm?
Yeah. No,
Yeah.
No, he goes out to them. He's not an insurance company.
Okay.
He's the guy that goes to the company to get the best fit for you. How do you work, Steve? You're like a quote, a middleman, so to speak, right? You're a broker, you might say.
Correct. We're a broker and we design the policies internally. So I mean, again, but that's my background, insurance nerd, designing policies for corporations. So if someone says we want to work with you, we'll set the policy up, show a different number of companies and products. If you choose, okay, I like option A with company B, we're paid a commission from the insurance company that we broker it through. And of course, it's always maxed out for cash value.
So he's my guy, but he got me set up through Guardian. All right, and he works with Guardian and all of that. So that's how that works. It's just like, say, the bond guy isn't the guy with the bonds. He's just the person that gets you set up with the bonds. Good question there. Ashley.
So you said the policy technically goes to 100. Like if I make it to 102, does it cash out at 100 or
Well,
something?
she probably will.
Good question. So no, it does continue to grow from that point forward. What happens is the guaranteed rate on a product, whatever the guaranteed rate is, say it's 3%, that's guaranteed up until age 100. Like if you read the contract language. However, policies remain intact until one hits 121. That's how actuaries got their mortality tables figured out. So if you make it to 121, then you would have to choose, do I want to, well, actually you wouldn't have this choice. They would say, here's the total death benefit. You can have it because you outlived anyone that was ever insured.
That's a beautiful question. Okay, anything else for Steve? Over here, David said you, Avila Beach, California.
How do you get a higher guaranteed rate?
Good question. Yeah. So it does depend on the product. For years, from about 1980 up until the end of 2021, the guaranteed rates were all at 4%. Just with the low interest rate environment, there's an update in the industry. Different products will have guaranteed rates that range between 2 and 3.75%. And it is a situation where it is what it is. So we do like to look at the different options, but you'll always see it range from 2 to 3.75% in the guaranteed rate. And there's pros and cons to a higher guaranteed rate versus a lower guaranteed rate.
In other words, they pay what they pay. There's no way to, you don't work this because I want to get a higher yield, right? They are what they are, and they have the benefits they have at the cost that they have. Okay, good. Great questions here. Anything else? All right. And last words here, Steve. Now, Steve, will you answer people's questions? If someone has a policy and they're not quite sure what it is, will you explain to them what they have so they can understand more?
Yes, absolutely. I know over the years, a couple of your people have done that. Yeah, you can always reach out whether you have basic questions or if you want us to take a look at any policies. And what we always do is if there's any changes you can make first with the existing policy, like we'll always recommend that first before starting a new one because it's based on the age you started. But the answer to your question is yes, we will look at that. No problem.
He's another great resource, a great winner's edge friend. Go ahead, Emily.
What is the minimum to start?
So you can set that wherever you want. We've got some people that have minimums of $500 or $1,000 per year. So kind of where we reverse engineer it and we ask, how much do you want to pay in? If someone said, I want to pay in a max of $5,000 per year, that means that minimum premium piece would be at $500 per year or as close to that as we can get it. So to answer your question, we can set the minimum wherever you'd like, unless we're a bit older in our 60s or so, then the minimum is typically around $1,000 to $1,500 a year.
Is that something you can increase? over time?
Good question. No. A lot of times people do want to do that. They say, hey, I'd like to add more to my policy. Can I increase my minimum now? No, wherever we set our initial minimum, we're locked into that. So if we want to add more than what that minimum allows, then we would need a new policy to do so.
So you could, it's possible you could have two policies if you wanted to start to contribute more? Is that what you think?
Correct. You can easily
Okay.
do that. Yep.
I see. So she could get going and down the road, income increases. She wants to do more. So she could have a second policy so she could put more into whole life if that was her goal.
Correct.
I see. So that would have to be done. Okay, can't just rewrite the policy. Go ahead.
Starting younger will build up more over time and accumulate more over time, correct?
Yes, you're going to be a decamillionaire, Dave. No more further questions from you. Okay. No, the answer is yes. He's talking about the compounding effect if he starts young. This is tremendous. And he didn't probably have time to show us. If someone like that and you go out 30 years, let's say he contributes for 30 years, okay? And let's say he doesn't draw the money out for till the 35th year, it's going to be big. Big. You'll be ahead of the game in a few years. And after that, it's just the interest pays the premium basically, right? And then everything else that's gravy, and now that's compounding and that's compounding. And it really starts to do this thing right here. Yes, very powerful.
Got it.
That's the beauty for you is, hey, if you can get people started early, they're going to be able to take advantage of this compounding over time because the money is like automatically going back into itself, right, Steve? If money doesn't come into an account and I got to tell you to reinvest it, it just keeps on going within the machine. Yes?
You got it.
That's the beauty right there. It removes the behavioral problems of humanity. Yes, over here, Dave.
So follow-up question to that, what's the youngest age you could start?
Yeah, typically you've got to be at least 6 weeks old. So a parent starts for a minor. Yeah. Yeah. Sometimes 2 weeks. Yeah,
Or you could start when you're 70, right? If you really
correct.
pump a chunk in and turn around, earn interest and all of that stuff.
So how we met Tori, our good friend that introduced you and I, he started his actually at 74 years old. It was 74, 75. Yeah.
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 Okay, back here, Kurt.
Can you fund a policy for a child?
Can you fund a policy for your kid?
Yes. Very easy to do.
And a good idea to get them, because you can make contributions for say 10 years, never contribute anymore and just let it grow. Don't tell them about it and give them a nice big surprise when they hit 40.
You got it.
Oh, by the way, we started a policy with you 39.5 years ago. Wow. Merry Christmas, right? Okay, all the way in the back, Greg.
Is there a max number of policies you can have?
Max number of policies you could have.
Not a max number of policies. There's a maximum amount of life insurance you can have. So insurance companies regulate that. It's based off really your income and total net worth. So there's a total death benefit that is a limit, which when cash value is the goal, it's rare to hit that. On occasion, we do run into it, but it's difficult to hit it.
Yeah, that would be a pretty big player, wouldn't it? Who wants to try to get a return that bankrupts the company, right?
Correct. And there's a point where they say no too when you get the death benefit too high. Yeah.
Yeah. Oh, great stuff. Okay. Plenty for Steve. He's available. He's a great resource. If you have any questions about life insurance, anything, he'll give you the straight scoop. Okay. Big round of applause. One more from Jeremy.
Okay. Appreciate it. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.